G'day. I'm Stefan Angelini. Thanks for tuning in to another economic wrap here with Angel Advisory. Today, we're just going through what AMP sees their economic outlook. So we're going to look at their global outlook and Australian outlook, but in particular, we're going to focus on the key rationale and their views around different asset classes. So asset classes are global equities, Australian equities, government bonds, corporate bonds, property and infrastructure as an asset class, commodities, and then the currencies. So if you've got superannuation, you'll see that these are in these, you have investments in most of these asset classes. But in particular, some of the risks they're focusing on are recession risks and the impact of interest rate hikes, China's reopening, the Taiwan risk, so potential, war, and some of the other geopolitical risks, such as the impact on gas and oil and Russia and food prices and all that other jazz. So if you want to stick around and listen to this entire video, head on over to the podcast or Spotify or YouTube channel and search for Real Wealth with Stefan Angelini. If you're staying online, thanks a lot for listening. Just letting you know that this is just general information. Please don't consider it as personal advice. And if you want personal advice, go and speak to a licensed financial planner. Guess what? Hey, we are licensed financial planners over at Angel Advisory. So if you want any discussion points, I'd like to say, reach out to us on hello@angeladvisory.com.au or check out our lovely website, angeladvisory.com.au. All right, now let's get into it and talk about what AMP have said. So short and sweet, what they're saying is that from a global outlook, they're seeing inflation pressures ease. The central banks starting to put on the brakes with their interest rate increases. And hopefully that means better valuations and better returns for 2023. In Australia, they see a slump in consumer spending, so rate hikes really starting to affect the cost of living pressures. There's going to be falling house prices that continue, and weaker global growth will mean that Australia will have to slow down as well. They still think that risk of recession is high. However, they're pretty confident that it will actually be avoided here in Australia. However, around the rest of the world, they say that recession risks are quite high and a lot of economies may fall into recession. Let me go on market specifics. So we'll start with global equities. AMP said that there are downside risks in the short term. They're going to be highly volatile, but expect moderate single-digit return. So a single-digit return, as an example, if you want to double your money every 10 years, you just need to make 7% per year on average over a 10-year period, and you've doubled your money. The reason they're saying that global equities may be okay is that they see there's still going to be rate rises, high inflation in the short term, but longer term, they see easing inflation, better valuations, and a pickup in growth to boost earnings and shares. So towards the end of the year, you might see a nice little kick up in global equities. For Australian equities or Australian shares, they see the share cycle to be similar to the global outlook. However, they see Australia to be performing a little bit better than the global equities counterparts. Basically, why do they believe this is going to be the case is because they see the strength in China supporting our economy prices, our commodity prices, and investors looking for higher yield here in Australia. So in Australia, we've got a grossed up dividend yield of around 5.5% that people earn from investing into Australian equities, which is fantastic. And with the China opening up, they will start to demand a lot more of our commodities and a lot more of the things that we produce and we are awesome at producing. So hopefully AMP think that Australia is going to outperform compared to the rest of the world. So let's hope that is the case. In terms of government bonds, they say that government bonds are going to provide better returns than they have at least, but with aggressive rate hikes already priced in and slower inflation, there's less hawkish central banks. Therefore, long-term yields will start to decrease, and therefore you might find that your bonds might perform better over the long term as rates start to decrease as time goes on. In terms of corporate bonds, these are a bit more on the higher yielding side, so you want a better return from a corporate bond. They expect these to keep rising, especially as rates continue to increase, but they expect the credit spreads to slow, even though there's been increases recently. So they see company earnings growth will grow. It means credit spreads will fall, but corporate bonds will still provide a pretty good yield. A yield is an income return, if you don't know. From a property and infrastructure perspective, they see some slowing in commercial property and infrastructure sectors, but also Australian home prices to slowly or to keep falling further into 2023, which isn't going to be great, but you can understand why. So with rising interest rates, that's going to hurt the unlisted asset market as well as the just general real estate market. Higher inflation means there's going to be higher interest rates, and then higher interest rates means there's better risk-free returns from these income-producing assets. But a lot of the times, a lot of these, assets, infrastructure, property are linked to inflation, and their prices are. So as inflation starts to decrease, you might see these price of these assets start to decrease too. In terms of commodities, commodity returns, they seem to be moderate. They've been pretty high as of recent, but they expect that the prices could stay high simply because of supply disruptions and strong demand. With China opening, there's still going to be strong demand, and with Russia still not doing what they're doing, and a lot of that geopolitical risk, there's just issues getting supply onto the markets. That plays well into our commodity producers. That might be the one thing that leads Australia into avoiding a recession. From a currency perspective, they do expect the Australian dollar to remain volatile, but they see a rising trend likely over the next 12 months. So getting stronger and against the US dollar, so a declining US dollar, mainly on the back of our commodity prices and strengthening commodities. That's the main reason, but a stronger Chinese economy will play well into our Australian dollar, so they will demand more things from Australia, and that might mean a higher Australian dollar. Now, just so you know, we're going to release something just around the effect of currency on both investment returns and the performance of different economies as their dollar changes. So a higher Australian dollar might mean it's not as good for our economy, but it just means companies do make more money. So that's a bit of what AMP is seeing around the place. Hopefully you like that good little update to keep you up to speed with what some of the big heads of the world are thinking. Hope you enjoy this one, and we will see you soon. Thanks for listening.